All right, today I'm going to do a little bit longer video where I look at earnings power of a company. And we're going to take a look at this company, LL Flooring's, ticker LL. As always, this is not a recommendation for this thing. If anything, I don't really have that much interest in this company, to be honest. But what's nice about it is it does a good job of presenting us with a good teaching instance of how to think about the earnings power of a company if things turn around, right? So I'm just going to walk through basically a back of the envelope exercise that I do with a stock, kind of my first effort at trying to decide, hey, is this worth taking a deeper look at this company, okay? So we can see the history of this company is kind of interesting because leading up to the COVID crisis, this company, there was a bare thesis that they were purchasing flooring with toxic chemicals, basically was the short argument for this company. Turned out there wasn't really a lot of merit to this, and then this company became kind of a poster child for people redoing their kitchens or redoing their homes during the coronavirus shutdown era, right? So this stock, it went from, troughed around $4 a share, you see here, and it went to 30 something. So we had like a $9x movement in the stock, and then of course it's given it all back and then some. So now we're back down to $3.85. Okay. Now we're going to take a look at the income statement, and again, Seeking Alpha is just great for getting all the basics about a company, and we're going to look and see here at the past history. Here we're looking at about $1 billion $1 billion a year in revenue, pretty much each year. Now, we can see that last year they printed $1.1 billion, but there's a nuance here, which is they keep opening new stores. They have been opening new stores, and so the growth is a little bit misleading. What you want to look at with a retailer is same-store sales growth, which is something that they will quote in every conference call. And for example, if I remember right, the last conference call, the same-store sales number was -9%. So this company actually, on an apples-to-apples basis, comparing the existing store base last year to that same existing store base this year, in other words, if you block out opening of new stores, their revenues are actually down. And we want to think about that number when it starts to flatten out or starts to decline at a lower rate. That's when we might take a chance to really look at this company. If we don't see that number sort of steadying, that's kind of not so good for the company, right? So we talked about this in video number 50, where you look at the first derivative. Also in video 113, where I did an exercise with Tupperware, where they just had negative comps that were very bad, and you just want to wait until that stabilizes, okay? But this is sort of secondary to our calculation of looking at earnings power. Okay, so here's in 2020, which was the 2020 and 2021 is where they printed operating income of pretty good numbers, right, compared to the prior years and the years that follow. So if we look at 2020, we had a $53 million operating income number on revenues of $1.1 billion, give or take. So 53.8 divided by 1097 is about a 4.9% operating margin. Okay, so hold that in your head for a second. And then the following year, we had 1.152 as a revenue number, and we had $60 million in operating income. So 60 divided by 1152 is about a 5.2% operating margin. All right, so if we were to just pretend, hypothetically, that this company went back to this operating margin, and this would be my exercise to try to think about what would they potentially earn if that were the case. And we can see here that they're clearly not earning a 5% operating margin now. They have a negative operating margin. And why is that? Well, their selling general administrative expenses went from 380 to 412, and the revenues were actually down a little bit. So we can see that they're actually losing money on the operating line. Okay, so then you kind of want to think of what are comparable companies likely to print for operating margins. And one of the best example of a company in this sector would be something like Home Depot, which prints 10% operating margins. Now, Home Depot is a great company. It's really, really well run, much larger scale. And it's going to be able to extract more concessions from vendors and from people that sell product through them. So probably Lumber Liquidators getting into a 10% operating margin is highly unlikely. Never say never, but probably unlikely. So I would say if we're going to choose kind of a bullish but plausibly bullish outcome, we would just have them returning to what they were at before, which is this 5% number. Okay? And then we just go through and we look at the other factors that we have to subtract out. So companies often will have interest expense, and this company, there's a nuance here. In the past, they haven't had interest expense because they haven't had any debt, but now they actually do have some debt, so we have to calculate for that. And then we have to put a tax rate on it, and then we want to look at our share count. So first of all, we look here, we've got about 29 million shares. And this is how I just do this very back of the envelope, like practically a cocktail napkin version of calculating this. Of course, you can build a spreadsheet if you want, but so what I would do is I'd start with a little bit conservative number for revenues. So call it $1 billion in revenues. And then we're going to look at a 5% operating margin guesstimate. So what does that yield? $50 million in operating income, right? Now, interest expense, this is a little bit interesting. Now, in the past, it was 0, right? But I don't think that is appropriate going forward. And that's because we have, and here we have to go to the balance sheet. We see here financials, balance sheet, and scroll down and you can see that they took down $72 million in debt. It actually turned out that they drew some money off of their revolver. And I think they're paying about a 5 and change % interest rate on this. And if we also look here, we see the income statement on the cash level, the cash line here. So we had a peak cash of $169 million. Now we're down to $10 million, which is a pretty low number. So if I had to guess, they're probably going to draw down some more debt or borrow some more. So what I would do is kind of be a little conservative here, and I would just take the current debt number and normalize it at double that level. So I would just say, in fact, let's gross it up to $150 million, and we would call it a 6% interest rate on that. And this is a guess, okay? Remember, we're doing cocktail napkin math here, but we're going to look at 150 million times 6%, and that yields $9 million in interest. Okay, now that's an expense, so our pre-tax income is not 50 million anymore, it's 41 million in pre-tax income. Now we're going to put a tax rate on that, so $41 million, where you subtract 25% of that. So, or the other way to think about it is multiply that times 0.75, and so that leaves us with $30.75 million in income. That's our net income number. Now, we have 29 million shares, so we divide by 29. And again, this is why this is kind of a good example, because it works out to just about $1 in earnings, 1.06 in earnings per share. Okay, now, again, this is if things return to their prior peak. I don't know that that's going to happen, but if it did, we'd be looking at a company earning around $1 a share. And if you look at a stock that's trading at 3 something, and it's possible that they could earn $1 a share, that would be pretty bullish, right? And so that's kind of interesting to think about. Now, likewise, I would say we want to think about maybe what kind of PE ratio you would put on this $1 a share. So if you consider this, say, a middling caliber retailer, maybe you might give it maybe an 8 times PE ratio or maybe a 10 times PE ratio. And so this would imply a $8 to $10 stock. Again, assuming things return to normal. Now, of course, the presumption is we don't know what's going to be normal for this company in the future, but under this kind of scenario, this would be sort of a way to think about a bullish case for your upside. And so that's it. That's basically, it's a very simple exercise where you rough out using prior operating margins or prior implications from the company's results. You sanity check that against comparable companies, and I gave the example of Home Depot, and I took an estimate that would be much lower than the industry standard or the industry best practice operating margin would be. And then we just work out what the earnings per share might be if we went back to this kind of earnings potential for the company. So, if you're super bullish, you think this company's due for a turnaround, You can make an argument, admittedly kind of a stretchy argument, but you can make an argument that this stock could go to maybe $8 to $10 a share. If they would earn more, the stock price could go higher. But of course, the company has to make it through and get to this point, right? So that's really the exercise. Again, I don't know what's going to happen with this company. And I would say also, just as an exercise in, let's call it intellectual balance, I actually think this article here from Seeking Alpha, it came out actually today, interestingly. This is a bearish argument on lumber liquidators, on LL Flooring, and it's quite well argued, actually. So you want to read this, and whenever you're doing an investment, you have to give weight to the bear case or the opposite case, the contra argument. So if you're a bull on a stock, you want to make sure you know the bearish argument better than the bears do, right? And likewise, if you're a bear, you want to make sure you understand the bullish catalysts as well as any bull. So this article actually kind of walks through the problems, and you get done reading it and you're like, okay, this stock is probably a push. I'm probably not going to do anything with it. This would be sort of, would be my opinion. And of course, I'm not making a recommendation, but this is sort of was my takeaway. Like, we have a scenario where things could play out okay, and it implies upside, but I don't know if that scenario is going to happen. But we've at least bracketed kind of, what the scenarios might be. Okay, so that's it. That's basically the cocktail napkin version of looking at earnings power for a company. And as always, I thank you for watching.